Hello and welcome. In this lecture video, I will continue talking about these accounts that affect equity. I just wanted to go over that one more time. Also talk about how to calculate an account balance, how to post a transaction to the general ledger, and then I would like to do one example of a journal entry, okay? All right, so as I was saying earlier, the way to increase an asset is with a debit. The way to decrease an asset is with a credit. The way to increase a liability is with a credit, decrease the liability with a debit. The way to increase equity is with a credit, decrease equity with the debit. So owner's capital increases equity. So then if owner's capital increases equity, the way that I would increase owner's capital is with a credit because credits are the way that I increase equity. The way that I would decrease owner's capital is therefore with a debit. Owner's withdrawals, they decrease equity. So to recognize an increase in an owner withdrawal, I would debit owner's withdrawal because as withdrawals goes up, equity goes down, and the way to recognize that equity is going down is with a debit. Revenues increase equity. The way I increase equity is with a credit. Therefore, the way I increase revenues is with a credit. The way I decrease revenues is with a debit. The way I decrease equities is with a debit, right? Expenses, as expenses go up, equity goes down. Therefore, the way I increase expenses is with a debit. The way I would decrease expenses is with a credit. So these debits and credits down here for owner's capital, owner withdrawals, revenues, and expenses really relate to the way I just increase or decrease equity, which is the way I increase or decrease the right side of the accounting equation in terms of debits and credits. Okay, so that's what I'm trying to get you to understand. Rather than just memorizing all this, if you can remember that the way to increase equity is with a credit, the way to decrease equity is with a debit, and then recognize that owner's capital has a positive relationship with equity. Owner's withdrawals has a negative association with equity. As owner's withdrawals go up, equity goes down. As revenues go up, equity goes up. As expenses go up, equity goes down. Therefore, the way to recognize an increase in expense, because as expenses go up, equity goes down, is with a debit. Okay, if you know these four accounts that affect equity, and then you know and you remember how to increase assets in terms of debits and credits, how to increase liabilities in terms of debits and credits, and equity in terms of debits and credits, you can do any journal entry. Okay, you can do any journal entry because, as we'll see when we do an example journal entry, we'll figure out which accounts are being affected, and then we'll come back and look at this diagram to say, oh, okay, I know that cash is going up and accounts payable is going down, for example. Or better yet, cash is going down and accounts payable is going down. So cash is going down, accounts payable is going down. How do I recognize that in terms of my debits and credits, right? Well, accounts payable is a liability. So I would debit accounts payable. Asset, my cash is also going down. Cash is an asset. How do I recognize that assets are going down? It's with a credit. So I debit accounts payable, credit cash. That's my journal entry in terms of debits and credits. And that journal entry is how I recognize transactions and how I record transactions. And that's a really big part of accounting. Okay? So when we continue on the next page, we talk about how to calculate the balance in account. And so remember, we talk about that idea of a T account, which is a visual representation of the account in the general ledger. So if we look at this figure, for example, cash, remember the debit side is the left side of the T account. The credit side is the right side of the T account. Because cash is an asset, and the way I increase an asset is with debits, the debit side of the cash T account represents increases to cash. The way cash is an asset and the way I decrease cash is with a credit. Therefore, the credit side represents decreases to cash. So how do I figure out my balance in cash? Well, if we look over here, it says we have an investment by the owner of $30,000. They got paid $4,200 in consulting revenues, and then they also collected on an accounts receivable. Basically, that means a customer paid us $1,900. So all these are collections of cash, increases in cash. And then if we look on the credit side, we see purchases of supplies, purchases of equipment, payment of rent, payment of salaries, payment, accounts payable, withdrawal by owner. Think about what all these are saying. Purchase. Well, when you purchase something, right, you have to purchase it with cash. You buy pencils, you buy paper. What happens to your balance in cash? It goes down. So all these are credits to cash, and they represent decreases in cash. So if we look over here, we can see the balance is $4,800. How did I get that? We take the $30,000 debit plus the $4,200 debit plus the $1,900, all the debits to cash, and we subtract all the credits to cash. And then we come out on a $4,800 debit balance. Remember how, as I was saying in the last lecture video, that the normal balance for an asset account is a debit. Okay, that's why this is $4,800 debit. If this were $4,800 credit, that means we have spent more than we have overdrawn our cash account. Okay, that's what that means. And you may have done that in the past. I made that mistake in the past. And, I forgot I had some outstanding checks, and I got a little notice from the bank saying, you know what, you overdrew your checking account, and we moved some money automatically from your savings account into your checking account, and we're also charging you a fee. Okay, so that's what would happen over here. Okay, and that would be a problem. So the way I can calculate the balance of an asset account is I can take, if we think about that, I can take add up my total debits and subtract my credits, and then I would have my debit balance. Okay, the way I would calculate the balance of a liability account, though, is because the normal balance for a liability is a credit, I would add up all my credits and subtract my debits. The way I would figure out the balance in owner's capital down here is I would add up all my credits and subtract out my debits. Owner's withdrawals, I would add up my debits and subtract my credits. For revenues, I would add up my credits, subtract my debits. And expenses, I would add up my debits and subtract my credits. Okay? All right? So if we think about what's the normal balance for owner's capital, owner withdrawals, revenues, and expenses, let's go ahead and define that too. For owner's capital, we should normally have a credit balance in owner's capital. For owner's withdrawals, it should normally be a debit balance. Okay? It would be odd to have a credit balance in owner's withdrawals. For revenues, we should normally have a credit balance in revenues. If we had a debit balance in revenues, that would be very strange. Expenses, the normal balance for rent expense or salaries expense, should be a debit. Okay? And what it says up here, the normal balance for equity account, what I'm talking about with that is this total balance in equity. That should be credit. But as I was saying down here, owner's capital, owner's withdrawals, revenues, expenses affect equity, but the normal balance for owner's capital is credit. Owner's withdrawals is a debit. Revenues is a credit. Expenses is a debit. But when we add up all these debits and credits for the total amount for equity, we should have a credit balance in equity. Okay? That's what we're saying up here, this credit balance, that bullet point. So in talking about journalizing and posting transactions, going back to that some of those discussions that we had in the first lecture video for Chapter 2 are step 1, analyze transactions and source documents. And we said, for example, we get a bill from a supplier, apply double entry bookkeeping. So that means, again, applying what assets accounts are being affected, any liabilities or any equity accounts being affected, and then discussing those or framing those in the context of debits and credits, and then also doing our T accounts. Step 3, doing our debits and credits in our journal. This is recording it in a journal entry in our general journal. So we put an entry into the general journal. That's why it's called a journal entry. And then step 4, we will then update our T accounts, which represent our accounts and the general ledger. So if we debit accounts payable and credit cash, that means cash is going down. So we would put a credit to cash on the T account for cash, and then debit to accounts payable means accounts payable is going down, but we would come over to the accounts payable T account and put a debit to the accounts payable on the left side of the accounts payable T account. Okay. So as I was saying earlier, if we look at step 3 on this page 27, a little bit more detail, we have our journal. So our general journal keeps all of our journal entries, which is a record of each transaction, in one place. It shows the debits and credits for each transaction. Again, journal entries are how we record transactions. In terms of a journal entry, we want to have the date of the transaction. We would want to have the titles of the affected account. So we would say, for example, January 1st, debit accounts payable. That's the affected account. Credit to cash. Cash is the other affected account. The title, accounts payable, and then cash. The dollar amount, so we would have to say debit accounts payable $100, credit cash $100. And then again, remember our debits, the total amount of our debits has to equal the total amount of our credits. And we'd also want to include a short explanation in our journal. So we would say something like paid off accounts payable, that was for purchase of supplies. Something like that. Some explanation. Okay. Then what we would do is we say over here on this bullet on page 27, the process of moving those journal entries from the general journal to the ledger is what we call posting. And if we look on the prior page, page 26 over here, that's talking about step 4, posting to the general ledger. So that's what I was saying earlier, is that we would come in to our general ledger. And if I look on the top of page 28, I have this figure, which is our balance column account. And this is an example of our general ledger. This is the cash account in the general ledger. And you can see we have cash up here, account number 101. Here, see, I'm listing the debits, which would be the increases in cash, initial investment, the credits to cash, any decreases, purchase supplies, purchase equipment, and collection of customer. That's an increase in cash. That's why it's called our debit. And then I'm constantly updating our balance. So I have my initial 30,000, and I say on December 2nd, 30,000 minus the 2,500 purchase of supplies gives me 27,500. And then I have my 27,500 balance on December 2nd minus the $26,000 purchase of equipment on December 3rd gives me $1,500 left over. And then I got paid from customer $4,200, $1,500 plus the $4,200 gives us the balance on the 10th of $5,700. Okay. So you can see over here, if we look at this a little bit more closely, we have the date on this. We have our cash, account number 101. We have the date, we have the description, we have the debits and credits, and then we update the balance. Okay, and this is a snapshot of the general ledger. The other way that we can visually represent an account in the general ledger is with the T account. Remember, it looks like a big capital T. The debit side, which is the left side of the T account, and then the credit side is the right side of the T account. Now, whether this represents a debit is an increase or decrease depends upon where it is in terms of the accounting equation. Remember, assets are recognized with the debit. So debit to cash means an increase in cash. Credits represent decreases to assets. Cash is an asset, so therefore that's a decrease to cash. But if this were AP, accounts payable, we still have debits on the left, credits on the right, because this is a liability. The way I increase the liabilities with the credit, decrease the liabilities with the debit. So it's reversed from cash. Okay. So I think I'm going to end this lecture video now, and then we will resume on page 29 by doing some example journal entries and simulating posting to the general ledger by doing T accounts. Everything that I've kind of talked about here, right here on page 28, the ending, I've already kind of discussed within the context up here. This PR is something I'm never going to discuss again, but it just stands for, just says it came from the general journal. That's all. Thanks. Bye.